So chances are, if you opened up some sort of brokerage account, whether that's through Schwab, Fidelity, Robinhood, whatever, and you just open up immediately, the default setting for your chart looks something like what is on the screen right now. This is called a line chart. And though this is what's used a lot of times for people to just kind of get an overall idea of like which direction their accounts are headed or whatever, this I would argue is not the best type of chart to have up when it comes to actually learning to read a chart and predict price action, or do your best to predict price action so that you can take a trade. And so we're going to talk about what kind of charts I use and stuff like that. Before we do that, I want to talk to you about brokers for a minute. There are a lot of different brokerages that you can use. I will just tell you what I use. I use Thinkorswim for all of my charting. I really like their, they look a little more complex maybe than some other charting softwares, maybe not as easy to look at as something like Robinhood, but you can do so much with it that you can't do with other softwares. And especially for just the everyday retail trader that's not trying to buy expensive professional software, I really like Thinkorswim. You do have to have a Schwab account to use Thinkorswim. Now, one way that you can get around like using them as your brokerage if you don't like them, at the time of this video, what you can do is you can open up an account and put like 10 bucks in it, and then you have access to their charting software called Thinkorswim, whether you actually use them to execute your trades or not. I actually use Fidelity for my trading because I like their fills, I like the prices they get on things, and I like their commissions on certain types of trades. And so I use Fidelity, but you can use Webull, you can use Robinhood, you can use Schwab, TD Ameritrade, Fidelity. There are all sorts of people you can use, but the charts that I'm going to be showing you are going to be specifically with Thinkorswim. And so let me throw on the screen my chart right now. Now, over here on the right side of my screen, what you will see is a very, very basic chart. What you want to do is the first thing you want to do with any charting software is you want to make sure that you have the candles turned on. Because almost every professional trader uses some variation. Some people use ticks or whatever, but some variation of a candle that shows you a better idea of what's going on in real time than like a chart or than like a line chart is going to show you. So let's talk about what these candles are, okay? The first thing I want to say is that when you see a green candle, all that means is that buyers were in control of that particular time period. So right now I have QQQ. I have their daily chart pulled up, which means for on these days where the candles are green, the buyers were in control of that entire time period. And on the flip side, whenever you see a red candle, those are days that the sellers were in control during that time period. And since this is a daily chart, it's set for one, each candle represents one day. That means that buyers or sellers were in charge for an entire day of trading. Okay, so that's the first thing I want you to know. Green, buyers in control. Red, sellers in control. Now, what makes a green candle turn green? What makes a green candle turn green is simply that this, so you have kind of two parts of a candle. You have the body, which is represented by this kind of open space or closed space on these red candles. And you have these wicks, which are these thin lines, okay? So what puts like the bulls or the buyers in charge on a given day is if the price opens lower and closes higher. And the way that's represented on this chart is the bottom of the body of the candle, like this one from January 8th of 2024. The bottom of the candle here is the opening price of the day at $397.99. And then the closing price is the top of the body of the candle, which was $404.95. On a red day, you have the opposite situation that happened here. You have the price opening at the top of the candle and closing at the bottom of the candle. That is, and closing below the price of the open. Okay, so green candles mean the price closed higher than it opened, basically. Red candle means the price closed lower than it opened. So what you had happen here is you had this price open at 408.35 on December 20th, but it closed down here at 403.08 on the 20th. And so it created a red candle. These wicks tell us the high and low of the day. So the top of the candle of any given candle is the high of the day. The bottom of the candle is the low of the day. So that shows you your price range for the entire day. All right. So what does this tell us? Well, a couple things. Not only does it show us who's in control in a moment, these wicks also tell us something as well. So what the wicks are going to do is the wicks are going to show you kind of these, like, I like to call them Gandalf moments. If you know what I'm talking about, the scene in The Lord of the Rings where he like slams his staff down and he says, "You shall not pass." When you see a wick, this is like a "you shall not pass" moment in the market. And so one example would be right here on this candle on January 11th here on QQQ. You can see that the price opened at 409.79, and it actually got pushed down at some point during the day to 404.24. Okay, but what happened there at 404.24 is the buyer said, "No more. You shall not pass this low price of 404.24." And they started buying that dip in the price and pushing that price back up to where it actually closed all the way back up at 409.35. So even though the sellers were still in control on that day, the buyers really stepped in and pushed that price way higher than it was pushed down to at one point in the day. And so there was kind of a "that you shall not pass" moment. That is what a wick says. The same thing happened. You can see that on the top of this same candle, at some point, the buyers pushed the price up to 411.20, and the sellers said, "You shall not pass," and pushed it all the way back down. Okay, so you can see all of this in a candle. All right, so what do these different things mean? Well, the first thing you need to know is that the longer wick is a stronger move. And so if you have a long wick in one direction, that is a strong move by, if it's on the bottom, that's a strong move by the buyer saying, "We're not going to let the price go this low. We're going to buy up all of these dips in price, and we're trying to push this price higher." Okay. And so it can almost be like a reversal signal. So like you can see on this candle on the 17th, you can see that price was pushed all the way down here to 409.29, and it opened here. So chances are what happened on this day is it opened at 406.17. The price was pushed down here to a low of 402.92. And then buyers stepped in big time and said, "That's enough. That's as low as we're going to let you get." And they actually pushed the price higher for the day. And then you can see the move that happened shortly after, because that was a "you shall not pass" moment. Longer wicks mean stronger moves. When you have shorter wicks, like this candle here on December 28th, obviously that doesn't have a lot of meaning. That's just normal price action. But long wicks on one side typically are a thrust in a certain direction. When you have long wicks on both sides, that is a sign of indecision. There's a lot of fighting. There's a lot of both sides saying "you shall not pass," and they're like willing to fight over those price levels and duke it out. All right. So that is kind of what wicks are showing you. Another thing I want to tell you is that when you see large bodied candles, you're showing a big amount of control. Like these are big moves. So like when you see on the 8th, you see this candle with a very large body, you're talking about there's almost no selling pressure on that day. Everybody is buying. You can see the same thing here on the 19th. Not a lot of selling pressure on that day. Everybody's buying. That's a big candle, massively in control. You can see a big red candle here on the 20th. That's a fairly big body. And even though it looks like maybe the bulls tried to hike it at some point, the bears came in strong and said no, and they were in control with that big body most of the day. All right, so that's the main thing that I want you to think about candles, because candles are the only indicator that you're going to look at that's going to tell you what's happening in the moment. All of the other indicators that we're going to talk about are going to be what I call lagging indicators. They're going to be things that are showing you price from the past and giving you predictions of the future based on the past. Whereas this is showing you what's happening in the moment, especially if you're watching like a live candle or you're watching smaller time frames. And so the other thing to know about candles is that there's really only three options for a candle, all right? The first one would be a directional candle, meaning, so if you look at its relation to the candle of the day before, it breaks the high of the previous candle and goes higher. So you have a directional candle up if it breaks the previous high. You have a directional candle low if it breaks the previous low, okay? So that's one. You can have a directional candle. The other candle you can have is you can have an inside candle. An inside candle means it never is able to break out of the price action of the day before. A good example of that would be this one here on the 21st of December. You can see this big move on the 20th of December, and then this candle stayed inside the body of that candle. That is a consolidation moment. So these are continuation. If they're continuing to break the high of the previous one, they're continuing in a certain direction, up or down. If they're staying inside, that's consolidation. They're not decided yet which direction they're going. And then the other one would be an engulfing candle. An engulfing candle, oh, here's one right here. Not quite. An engulfing candle, here we go, here's one. An engulfing candle means it breaks both sides of the previous candle, meaning it faked everybody out. People thought it was going to come down this way. People thought it was going to go up that way. Everybody lost money on that day, is what that candle tells you. Okay. So those are the only three options you have with candle. They're directional, either up or down. They're inside, or they are engulfing both directions, and everybody's losing money. And we will talk specifically about how to read these candles and how I use these candles on specific trades. But I want to know exactly what people are thinking and what people are doing in the market, and candles are the best way to do that. Something else you'll see on my screen is the volume. I have the volume bars on my screen. That's down here. This just shows you how many transactions are taking place in a day. And so if there is a big price move on low volume, maybe I'm not as concerned about that, because a big price move on a lower volume says, hey, not a lot of people were trading today. And so therefore, there's not a lot of substance behind that move. A large move on high volume, on the other hand, is going to say, okay, there were a lot of buyers and sellers that stepped in and the price went up. I should pay attention, because this happened not only in the price action, but it happened in volume. So I'm paying attention to volume as well. All right.